Yesterday, we talked about, my topic was you can't get rich at the bank. And I think it's important that tonight's topic, I kind of piggyback on that. And I talked about how banks give you 1% interest on your checking account, if you're lucky, 1% interest on your savings account, if you're lucky, on your CD, on your money market account, which is just a savings account with checking account privileges, if you're lucky. I talked about how most Americans try to get wealthy at the bank, and they don't understand that the mere fact that you're getting interest means there's a loan involved. Anytime you hear the word interest, a loan is involved somewhere. In order to get wealthy, wealthy people, we track the interest. We track the loan. So instead of you getting a retail return like 1%, you need to get 10, 15, 20% like the bank is getting. In other words, the reason the bank is giving you 1% is because they're getting 20%. The reason you're getting 2% is because they're getting 29%. So you think the bank is doing you a favor when the mere fact is they're not. They're giving you a small crumb off the buffet that all of our money collectively earns as they become $1 billion institution and then give you pennies on the dollar, literally. Those are called cash equivalents. I talked about it all day yesterday. But the thing I got to drive home to you guys is anytime you hear the word interest, you need to track the loan. So if your money is safe in the bank, shouldn't it be safe enough for you to own a piece of the bank? Just something you might want to think about. In other words, if your money's safe enough for you to be investing, quote unquote, in your checking account, which is not a good investment because it doesn't bring anything back, but you are investing, it's just that you aren't getting any returns. You're investing in the bank's investments and they're giving you 1%. So with that being said, I think it's only right that tonight we pull the curtain back even more and talk about the banker's secret. That's right. The bank has a secret. Now, this is important. I want you guys to know where I'm coming from with this. My background is banking, okay? For those that don't know, I went to Morehouse College. I graduated with my degree in English in 1997. I thought I was climbing somebody's corporate American ladder, only to realize that my ladder was on the wrong building. I can't give you guys the name of the company, but they call it the Bank of America. When I was at the bank, I saw different aspects of banking. I worked in the credit department, so I saw the importance of having a good credit score. Even though my credit was so bad, you couldn't staple any more sheets of paper to my DeRogs, okay? DeRog is a negative mark on your credit. I had bad credit and stapled reports to it to explain what went wrong back in the day. Now, then I worked in as a teller. I literally was the person you would come and see. Thank you, welcome to Nations Bank at that time. Now they call it Bank of America. And I take your money, put it in your account, your balance pops up, and I'm dealing with all these people with all this money. And I go back to my apartment and I'm broke and struggling. Not a good feeling. Then I worked in what's called construction lending on a commercial side, where I saw supermarkets and like Walmart and Target, how they go in, that's called an anchor. The anchor buys a certain amount of property, they rent, and then everybody else around the anchor succeeds, like your nail salon, your barbershop succeeds because the anchor, if the big dog eats, everybody eats. So I saw how that worked. And then I worked in what's called residential lending, where I saw subdivisions get built. Long story short, I used to be a banker. And here is what everybody needs to understand. The person at the counter is not the banker I'm talking about tonight. The teller is not the banker. That's a bank employee. The person that's dressed a little better across the aisle sitting at the desk is not the banker. That's the bank employee. The person I'm talking about is the gentleman who actually owns the bank. The CEO and the shareholders have a secret that they are not telling you, the retail customer, that they know and they'll never teach you. But that's why I'm here. We pull the curtain back and show you what's behind the scenes. So here's the key that the bank understands.
I have an idea for a meal prep food truck.
First of all, banks run off of charters. So if you have a local Southern bank like SunTrust, there's only certain things they can do. You have a much larger bank like Chase or Bank of America or Wells Fargo, there's a certain thing that they can do. Basically, those are all the same, to be honest with you. But my point is, banks have certain charters. So the banks I just mentioned, for example, they have to have collateral attached to any loan. So in other words, if you get your car note from a bank, if you don't pay your car note, they can always come get the car, right? There's a reason for that. If you don't pay your mortgage, they can foreclose and sell the house. There's a reason for that. The reason for that is that the bank is not loaning their money, they're loaning your money. So they have to secure it. That's why it's insured by the FDIC. We talked a little bit about this yesterday, but I'm taking it a different direction. They have to secure any loans because guess what? They're lending your money. Brian, how are they lending my money? Well, easy. You put your money in a checking account. That goes on the bank's balance sheet. The bank then shows that they have a certain amount of assets, which includes all of our checking accounts, all of our savings accounts, all of our money markets, all of our CDs. That take all our money together. They become $1 billion corporation. They loan money against this asset known as you. And then you have a liability known as the bank because they give you fees on your money. So let me get this straight. It's my money, but I pay a monthly fee for y'all to keep it. Everybody do me a favor and type no more. In other words, no longer will you allow the bank to keep robbing you by making more money off your money than you. So let me get this straight. Wells Fargo, Bank of America, Chase, PNC, and somebody else, it escapes me, made $5 billion last year on the backs of individuals who had insufficient funds. Now, let me make sure you understand what I just said. I didn't even name all banks. The big five collectively earned $5 billion in insufficient funds. So you mean to tell me I swipe my card, the money's not there, you go ahead and clear it knowing the money's not there, but then you charge me a $35 fee. Now, me being a responsible person, the truth is we both knew the money wasn't there. So I'm not acting like the person that gets the NSF fee is just like, is the most responsible person in the world. What I'm saying is the bank knew when you opened up your account, because it's a cash equivalent, that you would need that money relatively fast. That's why they give you a debit card attached to it. That's why they link your savings and checking account together so you can transfer funds, because they know eventually you're gonna milk both of them. So banks made $5 billion with a B. Just the big five made $5 billion off the backs of people off of the NSF fees, $24, $28, $32, whatever it is. So that means the rich got richer off the poorest of poor due to the bank fees. Now, here's the trick. Here's the new trick. If you had $98 in your account, right? Why wouldn't the bank debit the $76 transaction you had first, and then the the $30 transaction you had second? Because the second one would have cleared, the lower one would have cleared if the first one didn't clear. So in other words, they hit you with two NSFs because they went ahead and overdrafted it first, then took the smaller one. You see what I'm saying? In other words, the bank knows that, okay, if we take these pending transactions out in a certain order, we'll hit them with more bank fees. Now, that's not the banker's secret. I haven't even got to the banker's secret yet. I'm just giving you guys the capitalistic mindset of the banker. I'm not talking about the person that's handing you a lollipop. I'm not talking about the person with the nice tie, the nice skirt that you see that's helping you open up little Johnny's savings account. I'm talking about capitalism at the big level. The owner and shareholders of the bank know that the people will get robbed by monthly fees, NSF fees, stop payment fees, and wire fees, and end up with less than they started with if they give their money to the bank. Now, the secret is this. with the fees and with your money as an asset, they loan your money and use the rule of 72 to double and quadruple and 10x theirs. So tonight's topic is simple. The rule of 72 is a formula that takes a lump sum of money, and you can use this formula and your lump sum to tell you how long it takes your money to double. Here's the type of thing we're going to show you. The rule of 72 is a mathematical anomaly that has been known in the business world for years. If you take a lump sum of money, the rule of 72 is used to tell you how long it's going to take that money to double. So if you got $10,000, how long will it take to become 20? If you got $1 million, how long will it take to become 2 million? If you have $1, how long will it take to become 2? You guys have to understand, money's a tool. Money's supposed to work for you. You're not supposed to work for money. The rule of 72 states 72 divided by the interest rate is your money double. That's cool, right? You're like, what does that mean? What the hell is he talking about? I got you. Don't worry. 72 divided by the interest rate. The interest rate divided into 72 equals your money double. Now, let me tell you what I mean. In other words, let me go down to bare bones, because this is what most people are doing. If the interest rate is 1%, like what I talked about on yesterday's webinar, then that means it takes your money 72 years to double, because 1 goes into 72 times.
So now we're searching for the magic frequency. And we start with 100 hertz, and we look through.
So if your mom put $1 in your savings account when you were born, when you're 72, you had $2. Are you listening to the words coming out of my mouth? If your mother and father put $1 in your account when you were born, and that's all they did, you will be 72 when you get $2, because $1 goes into 72, but the interest rate is what you're dividing into 72. The interest rate of a checking account or savings account is 1% if you're lucky. That tells you how long it takes your money to double. So you'll be 144 and you'll have $4. And we know where you will be, you and the good Lord, at 144. So let's deal with some real numbers. I'm about to break down 3 individuals who all live in the United States. Now you can write this down and take notes on this, because this is something you have to teach your children today. Okay, if you want to change your family legacy, teach your children this. Take a sheet of paper and divide it into thirds, right? We want a column on the left, we want a column in the middle, we want a column on the right. I'm gonna show you 3 American citizens, and I'm gonna show you the bank. I'm gonna show you 2 American citizens, and then I'm gonna show you the bank. And we all are gonna start off on an even playing field, with the exception of our interest rate. Just our interest is gonna be different. Now, person number 1, person number 2, and banker number 3 are all 29 years old. So listen, guys, we're gonna have some fun tonight. This is real world, this is real life situation. We're all 29. Person number 1 is 29. Person number 2 is 29. Banker number 3 is 29. So we're all equal there. We all have $10,000. Person number 1 has 10 grand. Person number 2 has 10 grand. And banker number 3 has 10 grand. Everybody's equal. But here's the difference: the interest rate, the percentage. Person number 1 says, you know what? I believe investing all my money in a whole life insurance policy. Insurance man, nothing wrong with insurance. I think we all should have it. Insurance man said, hey, invest your money with me. I'm gonna give you 4%. So I want y'all to write that down. person number one invested their money somewhere in some wholesale policy at 4%. No problem. Insurance, I'm not knocking life insurance. You need life insurance. But the unfortunate thing about life insurance is you don't get the benefit from it. Okay. And well, Brian, my family does. Well, yeah, but there are other ways for all y'all to benefit, but that's another training. Now, you need life insurance, don't get me wrong, but it's not an investment, is what I'm trying to tell you. Now, person number two says, Brian, I found something good, man. I got a mutual fund that's paying 6%. Cool. We both 29 years old. One person's getting 4%. One person's getting 6%. No problem. 2-point difference. Banker number three says, you know what? We get double-digit returns. We get 12% on our money. Well, excuse me, Mr. Banker. Yeah, we get 12% because what we do is we take all the money and get a higher rate of return because everybody's money goes over to China in our investments anyway. We invest in the international market. We invest in wholesale rates of return. We invest in private business because we take all y'all's money collectively and then we give you 4% if you're lucky. Now, here's what I want you to understand. So person number one has 4% in your column, 29 years old. Your middle column, person number two has 6%. And in your third column, person number three has, banker number three has 12%. Now, here's what I want you guys to understand. I gave person number one, believe it or not, 3 advantages. Now, I know I laugh a lot, I smile a lot, but I'm serious with what I'm about to tell you. He's 29 years old, so he or she is young. I gave him $10,000, and most people don't have $10,000 right now that they can just touch cash. That's number two. Number three, 4% is something that most people are not getting at all because they still got their money in a savings account because that's where grandma told them to put it.
And no, I'm not saying you're lending them your own money, but I'm saying you can connect them with people.
Now we got to take the 4 and we got to divide it into 72. And the magic number is 18. 4 goes into 72 18 times. I told you, the banker knows a secret. You take the interest rate, divide it into 72, and the number that pops out, that's how long it takes your money to double. So your money doubles every 18 years at 4%. It doubles every 72 years at 1%. But let's stay with the 4%. So I'm 29. In 18 years, I will be 47. In 18 more years, I will be 65. So 29, I got 10,000. At 47, I got 20,000. At 65, I got $40,000. That, ladies and gentlemen, is most Americans. You ever seen that guy at the post office? He's working at the post office part-time, but when you're talking to him, he says, I'm retired. So I'm retired from General Motors, but you're talking to him at the post office and they got a part-time job he's going to when he leave the post office, but he get a Social Security check. You know what he's saying? All my stuff collectively is not enough. My Social Security is not enough because inflation ate into it because Social Security is based on the cost of living back when you were contributing. And then by the time you draw on it, the cost of living is sky high. So inflation ate into your social insecurity. Check not high enough. Pension, based on when he was working for General Motors a long time ago, and now the pensions don't even exist. So none of this factors in inflation, the fact that you 15 years older. He's working part-time at the post office when you're talking to him. And he's got a part-time job he's going to after that. You know why? He was person number one. He was getting 4% return on his money. He had $10,000. He was smart, saved up as much as he could, and he gave it to a banker who said, we're going to double it every 18 years. People, do the math. You need to get real about your finances, start doing the math right now. How long is it going to take my $10,000 to double so you don't get surprised when you're 65? So here's the question. Is $40,000 enough? And I started you off with 3 advantages: youth, money, and 4%. Because most people aren't 29, they don't have 10,000, and they're getting less than 4%. And that's how he turned out. Person number 2, before I go. Oh, Brian, I'm getting 6%. Talk to me. Talk to me. I'm smarter than that guy. Okay, 6%. You're 29. We got to take 6, divide it into 72. 6 goes into 72 12 times. So our money's going to double every 12 years at a 6% interest rate. So I'm 29 plus 12, I'm 41. I got $20,000. Now, the first guy was 47. I don't know if you're keeping your columns together. The first guy was 47 years old with 20,000. So 6% did do better. I'm 5 years younger than him, but I got 20 grand. We got to add another 12 years. At 53, I'll have 40,000. And at 65, I'll have 80,000. You know what? That's most people in America. And you know what? It's not enough. Your 80 grand will be gone. You're 65 years old. You've been working your whole life. And because you trusted somebody that told you that 6% was great, they didn't tell you it'd take 12 years for your money to double. How many 12-year increments in your life do you have?
This app on my phone called Audible helps pay for my bills every month. I'm sure you've heard.
You see? What, 8 if you're lucky? 8 if you 8, and you got 8 cycles of 12 if you're super lucky. Now let's look at old banker over here before we go. See, I'm piggybacking tonight's webinar off last night's webinar. Old banker is getting 12% off his 10,000, which is really your 10,000. Because I told you, bankers build billion-dollar assets off the backs of poor people. It's called capitalism. So they sold you a checking account, they sold you a savings account, they sold you a CD. They get 12% and give you 1%, and they take 12 and divide it into 72 6 times. Oh yeah. Now let's look at old banker. Not the person, the sweet young lady giving you the lollipop, not the nice gentleman with the towel telling you greetings and good night and good evening. The banker owns the bank, not the bank employees. 12 goes into 72 6 times. The interest rate goes into 72, tells you how many years it takes your money to double. That's a formula that your child should know right now. So let's do it. We're all 29 years old. The bank took your $10,000 that he got from the car you bought, interest. Let's get it. Let's talk real now before we go. We're gonna talk real about wealth. Let's be real about it. That's your $10,000. You had to have the car you couldn't afford. Write this down, guys. Interest is the penalty you pay for the right to own something in advance you cannot afford. So I hope it's worth it when I show you how much the bank made off your money. Again, interest is the penalty you pay for the right to own something in advance you cannot afford. That's what interest is. I'm telling you, I was buried in debt. But see, I only got wealthy once I saw how to make interest work for me. So then I'm about to show you how to become the bank. So watch this. 29, 6 years later, after 29, 30, 31, 32, 33, 34, 35, you got $20,000. 6 years later, 41, you got $40,000. 6 years later, 47, you got $80,000. 6 years later, right? 53, you got $160,000. 6 years later, 59, you got $320,000. 6 years later, 65, you got $640,000. Let me ask you a question. How's the banker doing? See? Look, guys, before we go, you got to get this. Everybody was equal. Isn't that what America tell you? Yeah, everybody equal, except your interest rates. Poor guy in the front, in the first column, ended up with $40,000 and he was 65 because he getting 4%. My man in the middle, right on, said he was getting 6%. So he ended up with 80,000. But the bank who gave you the 4% and gave you the 6%, they went and made 12% of all of our money collectively. So if your money's good enough to give the bank, why don't you own some of the bank and get paid off everybody's money? Because I'm gonna tell you something. He made $640,000 off your 10. 10, 20, 40, 80, 160, 320, 640. And he's the same age as you and use your money to do it. So my question to you guys before we go tonight, how long are you gonna be a consumer and not a banker? Brian, ain't nowhere in the world I'm gonna get 12%. Really? Who told you that? I'll prove it to you. I'm gonna prove it to you on the final webinar Sunday.
Hey, Clean. Instead of focusing on small clients or serving individual consumers,
I grew up on your music. This is South Miami, born